Hey everyone, welcome to this session of Unshakable Living, where we take those shakeable aspects in life and get it to that unshakable state. Today we're going to hit again Chapter 4 on protection and talk specifically on term life insurance. What it is, different types out there, and how to make sure you're getting the best value for your dollar on the protection for you and your family. If you didn't check it out before, go back to the last session where we talk about survivor needs and the amount you should be able to figure out what is right for you by going through that checklist. But now we're going to dive right into term insurance and what it is. First, there are multiple options for you out there. One of them a lot of people will hear about is called annual renewable term. Annual renewable term is just that. Every year you would get the policy, but then every year that term cost can increase. So you then decide, do I want to pay that increase? Therefore, it's a renewable term. At some point, that price gets extremely high. The positive of this type, early on, very, very inexpensive. Going to be lower than what are called level term policies that we're going to cover in a little bit more detail next. So adjustable starts off very low, but every year can increase. Some of them will have like the first 5 years, no major increase, but over time it will. So as that goes up in price, then a lot of times people will cancel them out because it gets too expensive to have for their policy. Majority of people I talk with like having a level term premium because they know exactly what they're paying for a certain amount of time. When you hear the word term, just in general, always think about it as you're pretty much renting this policy. If you outlive this term policy, so if you have it for, let's say it's called a term 20, which would mean for 20 years, you outlive it, the term of that policy is no longer there, you never owned it, so therefore the death benefit is gone unless you reapply for a different policy or pay an increase in premium. So again, keep that in mind. Term is, only way it really pays out is if you die within that time frame of the contract. Other than that, the insurance company will get all the premium. Reality on this, again, we have the boxing glove in the back, always punching people in the face with reality. Term insurance, one, I do love it because it's an inexpensive way to protect your family for that unforeseen event. On the flip side, only 1 to 2% of all term policies that are taken actually have a claim paid out. So that means the insurance company, 98 to 99% of the time, is just collecting that premium. That's why they're so inexpensive, because they know most people will outlive that time frame. So, getting back into it, level term policies. There's all sorts of them. Most common are a 10-year level term, 20-year level term, 30-year level term. There are actually now today 40-year level terms, and then everything in between, a 5-year, 15-year. I mean, you can even pick like a 9-year. So all sorts of ones, but usually it's 10, 20, or 30. On that, few things to take note of. One, if you don't have protection and you think, hey, I should have this on life insurance, get it right away. If you're young, don't have a family, but plan to have a family someday and plan to own a house, I would suggest, since you're young and healthy, or likely healthy, go get the policy again right away. Why? As you get older, the cost of insurance increases. You also take on all the risk of your health deteriorating. So if your health, for most people, as they get older, it doesn't improve, it usually slowly deteriorates. Hopefully you stay in a good health regimen, it stays good or even improves, but for most people it doesn't. When that happens, cost of insurance goes way up. So the earlier you can lock it in, the better. For an example's sake, I'm going to pull it up on the screen here. Here is for $1 million of coverage, just a bunch of different carriers, and also showing those different types, 10-year, 20-year, 30-year, and even a 40-year type policy. So on here, this is a preferred non-tobacco. So not the highest, but the second highest health rating someone could get for a 35-year-old male on $1 million of coverage. If they said, I want to lock this in for 10 years, so maybe they had a mortgage and it's going to be paid off in 10 years, and then they figure they won't have many liabilities, maybe this is a good option for them. Only $309 per year after 10 years though. Notice it says NA, meaning the price is either they're just going to forego the policy or the price is going to increase dramatically, but they aren't illustrating it here. If you go to the 20-year, notice now $529, so more than what it is on the 10-year right away, but again, after the 10 years are up, you still have a policy in place for the full $1 million all the way until, in this case, the person would be 55. Same goes for the 30-year and 40-year. 40-year, they're very new, so their pricing, I don't think they have that tweaked quite yet. I would say most people that are looking for a longer term policy go with the 30-year. So to kind of show that in work, what if you said, hey, I'm just going to wait 5 more years because I don't need it right away. Exact same health, 5 years later, let's do a quick reboot here and look at the 30-year. Roughly $900 on a 35-year-old. 4 years later, same health, but just age-wise, now it's over $1,300. Now, what if your health just deteriorated a little bit? So if going from preferred non-tobacco to standard non-tobacco. Now that 30-year is $2,116. So you waited 5 years, health deteriorated just a little bit, and you are now paying more than double for that same amount of coverage. This is a common mistake a lot of people make because they always figure, I'll wait until I really need it and then I'll go out and get it. Again, there's the proof in that scenario that you can actually save money by getting it in place earlier on, maybe when you don't even necessarily need it, but now you have that health and age locked in. Couple other things on term insurance and insurance in general. The one on term insurance and insurance in general, you can choose to pay as annual or monthly. Don't get caught on the monthly trick, especially on term insurance. Sometimes on a whole life, if it's a larger premium, you may want to still go down that monthly path. But in this case, we had the 130-year term was $1,312 to pay it annually. If you go to monthly, it goes to $119.75. So a lot of people would say, $119.75, yeah, that's doable monthly. Let's go with that instead of paying it all at once. Now, if you've been money savvy strategy followers, you should have that money in your savings to pay the full annual. Why is it smart to do it that way? If you do the math on the $119.75, it's about a 9 to 9.5% higher amount than paying it all at once. So if you add it all up, it's about $125 more per year on a $1,312 annual policy. Over the course of the 30 years, $3,750 more that you could have avoided paying. So if you have that in savings, pay that, because then you don't pay that bump up on the premium. Other item, going to really punch some people in the face on this. Do not wait until X happens. And by X I mean if you are a smoker. Maybe you smoke some marijuana every now and then too. That qualifies as smoking. Even though it's not cigarettes, still going to qualify as smoking. Tobacco users on insurance, especially term, it does go way up. Usually almost doubles the premium cost. The other X factor for most people, they're not in their ideal shape. They're maybe 20 pounds overweight, whatever it is, and they're going to get in better shape. I've heard this over and over again, and do not say you're going to be the difference of it. Make yourself the difference of it, of saying, yes, maybe I am a smoker today, but instead of, hey, I'll get it when I quit so I pay the lower premium, get the policy today, pay the higher premium for a year, and if you actually quit in a year, redo the medical exam, and you will get that lower premium going forward. Too often than not, I have people use the weight or the smoking excuse, and then they never do it. And unfortunately, I've seen the terrible side of it where one of them had the unfortunate event. They ended up dying early, and family had nothing because, oh, I'm going to stop smoking or I'm going to lose this 20 pounds. Make it a habit that's good for you. Get the policy in place. 12 months later, you can always redo the medical. And then if you did get in better shape or you stop smoking, now you get the better cost of premium. And it's also an incentive for you. Now you're going to pay less. Where if you do the other route, because you haven't started paying the premium, it actually is kind of a lose-lose where, hey, I stopped doing something I enjoy and I got to work for it, and then I'm going to pay something that I'm not paying now. So get that out of your mind, just get it right away and move forward with it. So with that, hit you in the face a little bit. That's what we have on term insurance. Again, next session we're going to hit the indexed universal, variable universal, and universal life and what those life insurance policies look like. And then we're going to end with a follow-up session on whole life insurance. Continue building a meaningful life. We'll see you again soon.